Good morning, good afternoon, and good evening to all of you, depending on where you're watching us from. And welcome to the ION Influencers Fireside Chat, where we speak to the sharpest minds from the world of capital markets. I'm your host, Giovanni Amodeo, and today with us, we have David Wilton, who is Chief Investment Officer at Oister Global. And the topic of today is having an outlook for Indian private markets in 2025. So thank you for being with us, David.
Thank you, Giovanni.
Great. So maybe let's start with your background first and then your role within Oister and what is Oister.
Sure. I've been involved in venture capital private equity investing for institutions for about 30 years. Initially, I managed the World Bank Pension Fund's private equity and venture capital portfolio back in the 90s. And then I was the first manager of IFC's funds group, investing in VC and private equity funds across the emerging markets from 2000 until 2014, and then with Morgan Stanley, and then onto the board of Loomis Partners, who are the founders, the creators of Oister Global, which is set up to do something similar to for the Indian market, if you think of Allocate or iCapital in the US. So basically, in our case, we're looking to provide greater access for Indian high net worth individuals to the venture capital private equity industry here that's been growing so fast.
So you talked about the iCapital model, and democratization of private market is one of the topics that is on the mouth of everyone. How have you seen this evolve in India over the last, let's say, 20 years?
Well, it's really fairly recent. And it's actually the motivation is a bit different to the motivation in the US. So in the US, it's the larger GPs of the industry who are finding that institutional investors are fully exposed. And now they need to find a new source of capital if the industry is going to continue to expand. So they're looking at retail investors. In India, the high net worth investors have been supporting the local market since its inception about 10 years ago. But now the market's grown and scaled and got more experience. The better managers are now onto Fund 3, Fund 4, Fund 5. And once they've got that sort of experience and track record, and also slightly larger funds, they can access foreign institutional capital. And at that point, they start to think the opposite of their US large counterparts. You know, they've got all these smaller investors. Wouldn't it be easier just to work with one institution for a $10, $20 billion check? And so what's been happening is the minimum commitment sizes have been rising and cutting out, high net worth investors. So we're sort of stepping in to try and fill that gap, and also fill the gap as the market gets larger and more complex. It's the job of identifying good GPs who are likely to have a sustainable track record gets that much more difficult. So we're stepping in to fulfill that role as well.
How big is the market in India, and how much has it been growing over the last 10 years?
You'd think I'd have that number off the top of my head, but I don't. The estimates are all over the place, but if you said 100 billion, you probably wouldn't be wrong. That's one estimate I've seen. But the growth has been very fast. I mean, it's still, and again, these numbers are rough because you use a different set of numbers, you get a different answer, but it's still roughly a tenth of the size of the Chinese market. But the rate it's growing at, the next sort of 5 to 10 years, it'll catch up in terms of scale. Just to give you some idea, I think the real way to look at it isn't so much size, because there still is a scale issue compared to the Chinese market and the US market. It's more maturity. I mean, is this now a mature, sophisticated, investable market? And I think the answer there is yes. And there's a number of things you can look at to sort of see that. One is, we do a report with CRISIL each year. They're the benchmarking and credit people. And the first two reports have both shown consistent alpha of the private markets here over public markets. And the public markets here have been doing very well. So that implies the private markets are really doing well. So you've got a market that's big enough and deep enough to have that sort of outperformance, which then means that anybody who wants to can apply portfolio theory to this market just as they can in the US market, which I don't think there's too many markets outside the OECD you can say that. Then you look at the number of GPs who are on Fund 3 or more as an indication of experience, and there's over 60 of them. And that number's been rising rapidly. So 60 GPs who've been successful enough over time to be on Fund 3, Fund 4, whatever. The market also is getting deeper in terms of sectors. So if you went back 10 years ago, I think it was over 70% consumer. Now consumer's down to about 20 something, and you've got fintech, agri-tech, services, services companies, climate tech. There's just a number of things. You've also got deep tech. There's actually quite a smallish but viable deep tech sector, and they're doing some quite interesting things. The other part of it is the regulator, and this market is regulated differently to the US, to Europe, to the sort of regulation that private markets are used to. And that's because the regulator, SEBI, is coming from a public markets background and expects transparency, just like breathing and drinking, which is not the attitude anywhere else. And so the reason we've been able to benchmark things so well is that if you set up well, the only way you can get into private market investing here is through an alternative investment fund structure, an AIF. So anyone who's got a registered AIF, which is anybody who's doing VC or private equity on the ground here locally, has to report every 6 months their results to one of, I think, 3, maybe 4 now approved groups. And Crystal is one of these groups. So every 6 months they get all the performance data, and you can create a market-wide index, which, you look at the US and Europe and you try and figure out indices. I think there's about 4 different index providers, and they more or less correlate, but it's not at all a unified system. So I think over time, this market will become more transparent than its older counterparts in the US and Europe.
You said a lot of interesting things, and I'd like to unpack some of those. But let's start from the last point on the transparency. How are international investors comfortable with this more and more stringent requirements in terms of transparency?
The investors, I think, are very comfortable. The LPs. The GPs, I think, push back a little because of the cost. But to be honest, if I was a GP in India and I had to overcome foreign investors, reluctance to move outside their home turf, I probably welcome the fact that there's transparency. There's something here you can trust. So I honestly, I think it's a good thing for the market.
And you talked about being 60 GPs which have raised more than 3 funds. How do you see the trends about adding different strategies alongside private equity?
You mean sort of sector funds or
just private credit or infrastructure, real assets?
Okay, so the growth has mainly been in VC and private equity. There is growth in private credit. I think there's 3 or 4 quite competent funds in that space. There's an increasing pickup in secondary positions and secondary investing. The infrastructure space, I'm personally not so familiar with. It's not something that we've been involved with. But I think the interesting thing is more within VC and private equity, just the expansion of sectors you can look at, and also the fact the market can support sector specialists. So if I'm thinking of, say, healthcare, there's Somerset Indus. I mean, when I was going back in time, when I was with IFC and we're looking to invest in emerging markets, I was highly suspicious of sector funds outside the US and Europe because they just had a deal flow problem. You couldn't get the selectivity you needed. Well, Somerset have looked at 800 deals and done 14. So there's no problem with the selectivity ratios. And that's the same for the other funds looking at other sectors. I mean, even in deep tech, Special Invest is a very good fund there. And their deal flow is more than they need to choose good, to be selective enough. So I think that's the interesting trend.
You talked about the investments, but also let's look at the exit. How many exit options are there right now in India? And how do you see the situation changing in 5 to 10 years' time?
Okay. There's the full range of exits. So from selling to another GP in the next round, if you're in the seed A, B space, to selling to a trade investor in another company, to an IPO. So all those things are functioning. So mergers and acquisitions, everything's functioning. And obviously, which exit is more probable depends on the particular stage of the company you're investing in. So the seed investors, early stage investors, obviously most of that is exiting on to the next fund in queue, and some out to to trade buyers. But the interesting pickup, there's two things here. One is the IPO market here has really been going very strongly. So there's been no issue with larger or even smaller companies listing in the last 2 years. So that's healthy. The other thing you're seeing now is bigger investors coming in and paying more attention to India. And that's probably going to have a knock-on effect, both in the M&A market and the IPO market. I mean, if you look at Asian healthcare buyout numbers, if you go back 5 years, India was a fraction of that. It was a tiny percentage of what China, the amount of the buyout money going into Chinese healthcare. The last couple of years, the Indian numbers are now, the amount going in is now pretty much double what's going into China. So there's that much sort of pickup in interest. One of the things in terms of exits is a style thing. You don't see very many GPs here, I'm talking more the VC end of the market, who take a Darwinian approach and say, I'm going to get 2 or 3 hockey sticks, that's going to pay for the fund, the rest can die. I know of one fund doing that, but people here are very frugal with their capital. They don't like losing money. And so a number of funds have surprisingly low write-down or write-off ratios. I mean, I mentioned Special before. They're in deep tech, it's seed stage. You'd expect them to have some sort of hockey stick with a lot of dead companies. They don't. They haven't had one actual write-off yet. Well, as of a couple of months ago, maybe not. But it's surprising. One of the things that surprised me is just how the GPs here, if a company's in trouble, they get into it and fix it. They don't let it die. And I think partly that is in a slightly smaller market. Maybe the number of hockey sticks is going to be smaller. So maybe to get your 25, 30% return, you need a higher survival rate. I'm just not sure, but it's certainly an interesting characteristic.
We heard that this approach of spray and pray, or pay and pray, is over, and not just in India. You talked about the attractiveness of the Indian market. Whenever GPs in India are raising capital and they are going towards international LPs, do they still need to say why India, or that question is no longer important?
Okay, so I think this may not be true for all LPs, but I think there's a group of LPs who were in India pre-financial crisis, so pre-2008. And the Indian market from then to now is chalk and cheese. There's no comparison. I mean, India has had 2 attempts to start, and they've both petered out earlier on. So in the 90s, there's an attempt to start a venture capital industry. That was in the days before digital tech, when everything was deep tech. The market just couldn't get it going. From 2000 until the financial crisis, you had a very rapid growth of what was labeled the private equity industry. In fact, at one stage, there were over 100 private equity funds. That was momentum investing. It was nothing to do with real value-add growing companies. And so when the financial crisis hit, there was a massive wipeout. And so anybody who's involved in that has a very bad memory of India. The current market is utterly different. And its starting point is really sort of 2009, 2010, after the financial crisis, when, and this was a global thing, venture capital started to spread out of Silicon Valley globally, based on a switch to digital tech. And for digital tech, you don't need deep research labs and military industrial complex. You need programmers. And India has programmers. In fact, I think at the moment, India is number 2 behind China in the number of software developers. I think China's something like 7 million, India something like 5.8. America's running third at about 4.4, something like this. So this move of digital tech out of Silicon Valley hit this pool of talent in India, and poof, off you go. So that was one thing, was international. On the domestic side, the government then, fortuitously, from about 2010, started to implement the sort of policies that unify a market and allow faster growth. So there used to be state taxes. They brought in GST to get rid of all those. So now a truck coming from a port with a shipment can pass through different states and get to the destination city in a day, a couple of days, whereas before it took 7 days, 9 days. They now got the roading system here is now second only to the US. The number of airports has doubled to 148. But there's all that unifying, which helps to create a unified domestic market and that sort of growth. Then on top of that, and this is where the connection to Silicon Valley is important, they brought in the digital stack. So this is, and I'm not a technical person, so I'm not the guy to really explain it, but basically it allows fast payment systems for everybody, fast ID checking for everybody, and they encourage entrepreneurs to clip on innovative businesses onto that. So firstly, it unifies the market again. You can get some guy out in a very small village somewhere, but he's got his PayTM card. He can digitally transact anywhere. So it's very powerful. In fact, I'm the dinosaur. I wander out into a market somewhere and try and pay with my credit card. Well, that doesn't work. You need a PayTM card, but I have to use cash, and I'm the only dinosaur using cash. So it really creates a much bigger and unified market. Now, the initiative for that, I mean, India's the only country that's done this. And I think it comes back to the very close ties to Silicon Valley, because when digital tech came out, India was sitting in the path of it with programmers. There are already people of Indian origin in Silicon Valley. I mean, at the moment, I think 25% of all new startups in Silicon Valley have Indian origin founders. There's something like 58 major tech companies globally that have Indian origin CEOs. So IBM, Microsoft, YouTube, you can carry on with the list. So all that linkage has been there from an early time, which means two things. One, this whole digital stack idea I think was probably influenced by that connection. The other is that the GPs here are not sort of totally homegrown. They've got to connect back to Silicon Valley. So there's a lot more sophistication than you might think if you're not aware of that.
And you talked about the growth of the market. You talked about the different GPs, the sectors, and so on. So what kind of deals are we going to see in India in 2025, 2026 that we haven't seen yet? And what is the opportunity for a provider like yours?
Firstly, I think just the current sort of very high quality deals that have been around across all the different sectors, so consumer, fintech, ed tech, and so on, that's all just going to carry on growing. I think the innovation, I mean, it's more a scale thing. The ecosystem sort of started at the small end and has now expanded, so the whole thing is functioning, right from seed through to Series B and Series E and so on, and then the private equity is also functioning. So I think we probably see not so much a shift in deals or sectors, but just more players of quality at each stage. So just an expansion of the opportunity in terms of scale. And then the one sector that I think is particularly interesting and is still growing is the deep tech. And I mean, there you meet people who are doing AI, they're doing rocketry, they're doing satellites. There's a guy who's got basically going from large drones to a flying taxi. And it may sound odd, why would you invent a flying taxi? But if you've tried to get from Delhi or Mumbai or Bangalore airports into town, you know the value of a flying taxi. And the thing here is that India's got an edge in being able to invent and create frugally. So you can go through many iterations of a business or a business model at a much lower cost than you can do that same sort of pivoting and changing in the US or Europe. In fact, it's one of the interesting characteristics of the market, that frugality in business models and development. One that allows you to create really interesting businesses here at a low cost and then expand overseas. And a lot of the companies we see are building things, not so much for the American market, but more to go into other developing countries. But the other is just the pricing, the fees in the market for VC private equity. Indian investors, because there's this frugal mindset, the Indian investors are really quite sophisticated. You talk to the family office people here, there's something like 300 family offices. There's a lot of wealth. And they're very sophisticated. They've been entrepreneurs. They understand businesses at different scales. So they know the business building's frugal. So why, as you as a GP, are not going to be frugal? So I think a few US GPs who've come into the Indian market have been slightly surprised that their Silicon Valley fee structures don't travel.
Do you think so? And that was going to be one of my next questions. What is that India is learning from overseas, and what is overseas learning from India? Is the fee one of them?
Oh, that's a very broad question. I think India learns more from overseas than overseas learns from India, because it's always the case that the guy who's coming up is watching the people further ahead and learning whatever they can, plus innovating in their own market. Whereas the guy in the market that's already big and famous tends to think they know it all, tends to think that their model is the best, so what do they have to learn? So I think the learning goes more from everywhere else to India. Now, I suspect that will change as there's more interaction, as people get to see just how frugally things can be built here, and some of the creative thinking that goes on. But so far, I think it's more a learning from the rest of the world to India. I mean, I'll be interested to see, just in terms of government policy, how many people, other countries, look at this digital stack and think this is a good idea. So far, I think the learning is in that direction.
A few final questions as we are approaching the end of the discussion. How much do you think India will be weighted in the portfolio of international investors now and then in 3 years' time, based on the trends you've seen?
I honestly don't know what the weights are now. I suspect at the moment, Indian venture capital private equity has a very low weighting. I think part of the issue is that right now you don't have a cluster of emerging market countries, or non-US, non-European countries, who create an interesting block. I mean, China was big enough to attract the attention, so you don't have that broader momentum effect that, oh, India's part of that, let's do that. So at the moment, you've got to make a choice of India for India. It's not part of some other broader geographic allocation. And I think people find that a little tricky, particularly very large investors. And given that this market is not as large as China and certainly is much smaller than the US, the scale for many very big investors isn't there. However, I think for anybody with a moderate, certainly family offices with a few $100 million to a couple of billion, they should be here, because the scale of investment fits. The returns are really very good. I haven't done a correlation check, but I suspect it's fairly low. And it's got the characteristics you want in terms of proven outperformance of the public markets. A lot of GPs on number 3, number 4 funds, you can do the diligence. You've got the numbers to do it. And just the growth path, and particularly since this is where I compare India with China. I would never underestimate the Chinese. I mean, I first went there in '78, and I've been back there roughly every 3 years since. But they've always had a central command and control, which can send things forward very fast or backwards very fast. And India doesn't have that. So whatever's been built to date in India, firstly, it's got fairly broad-based support. I don't think a change in government will affect the digital stack or anything that's been driving the growth. But it can't be sent backwards very fast. So what's here is here. You can see it. And also, you can see the sausage being made, and you can decide you like it or you don't like it. Whereas China, maybe the sausage was being made out in the kitchen and you couldn't quite see. So to that extent, it is much more transparent. So I would think whatever India's GDP weight is, I would certainly think that much of your VC private equity portfolio you should be thinking about if you're an investor with hundreds of millions to a couple of billion. If you're massive, if you need to invest several $100 million in one go in one fund, then your choice set's much more limited. But for anyone whose investment size is a few $100,000 to 10, 20 million, this is really a sweet spot.
You talked earlier about the sophistication of the family offices and, of course, of the GPs and LPs. What are the blind spots in the industry? Where are the inefficiencies still, and that you can help plug in?
It's still difficult to find information on GPs. I mean, but this is true of all VC private equity markets, even the US. It's hard to identify who's really good. So, and as the market gets bigger, that problem only scales. Okay, if I'm looking at, there's a difference as you start to meet more and more GPs. There's definitely a difference between generations, and I'm not saying it's good or bad, but there's a, well, I'll rephrase it. There's a difference in perceptions of fiduciary duty, and that's improved a lot. So I'd say, and it's not actually, I'll retract what I said. It's not so much a question of older versus newer GPs. It's more just, whereas in the US or Europe, people understand fiduciary duty. It's there, it's baked in. Now, they may turn out to be bad actors, but at least they know how to say the right thing. Whereas here, you can sense when someone really understands it or they don't. So that's one thing that is sort of a flag that we look for, that I probably look for a little more than I'd look for if I was just dealing in the US or Europe. And it's not that anyone's going to go out and do anything really bad. It's just that the reporting quality is going to be slightly less. There might be a corner cut that you don't really want cut. But let's not, I think, you know, certainly most of the GPs we're seeing, and certainly we've found a lot that are good. Yeah. The sense of fiduciary duty, the reporting, the transparency is all very good.
Great. David, thank you so much for your insights, and thanks everyone for listening.
No, great pleasure. Thank you, Giovanni.